In episode 1, we covered the why behind the market moves. Auction market theory and the volume profile told us where price is likely to react. Now in this video, we're adding the when and the how using the Elliott Wave Theory. This gives us a structural framework to actually count and predict the shape of a move before it happens. If you haven't watched part 1 yet, link is in the description. The title card should be up there. And so is my paper talking about these theories if you want to read that too. Something to help you. And yeah, let's just get straight into it. So, what is the Elliott Wave Theory? What the hell am I talking about? So, Ralph Nelson Elliott, who coined this theory, figured out back in the 1930s that, hey, the markets don't move all willy-nilly, bro. It's not like stupid, it's probability. There's things behind it that drives the market. He said that they move in repeating fractal wave cycles driven by one thing: human psychology. So we all been in that situation where money's on the line, right? We get in our heads. That's embedded in our system, right? When money's on the line, traders oscillate between greed and fear. We want more, but we don't want to lose anything. And if we do lose anything, we're in hopes that it's going to go back up. That's just how we are. And because the psychology is universal and consistent, not just among traders, the pattern it produces on a chart are universal and consistent too. Across different asset classes, across different time frames, the same structure over and over and over again. So what did Elliott say? What did he map out? He said that there's an 8-wave cycle. 5 waves in the direction of the trend, called the motive wave, and 3 waves against the trend, called the correction phase. Sounds like a mouthful, but let me break it down for you. Let me really walk you through this, right? So in the EWT, Elliott Wave Theory, what did bro really say? He said, yo, we got 8 waves for market structure. Alright, cool. But what does that mean? We have 2 distinct waves. So we have 8 in total. Then we break it down further into 2 distinct waves. Motive, happy, correction, sad. Motive has 5 waves, all following an uptrend. Correction has 3 following downtrend. So I just want to make this clear. Asset classes cannot go up forever. There must be a pullback. There must be something, right? They cannot just go skyrocket to the moon like that forever, right? Something has to occur, right? And it's usually driven by human psychology. So I'm going to draw this out for you. Let's start with motive phase. Right? So wave 1, simple pop, right? This is the first breakout. This is the initial move. See, institutions and smart money start accumulating at what they see as undervalued levels. Like, hey, this stock, hella good, but it's hella cheap. So like, let's buy it up. Let's get a position into this. To the public, it's like, okay, the stock's up today, whatever. It's not a monumental move for me to make a position, right? Volume is usually moderate, and most traders think like, whatever, I'm not going to put my money into it. Cool. Wave 2 is the pullback, right? As I said, everything can't just go up. There has to be some repercussions to this. So wave 2 is the pullback. Early buyers who caught these levels took profit. Sentiment is still like, do I really want to buy this? And price retraces. But there's a rule, which is wave 2 cannot retrace more than 100% of wave 1. The origin point must hold, and if it breaks, your count is wrong. Your count is essential for creating the shape and understanding, do we have a proper, like, optimistic rally behind the underlying asset? So I'll just draw out the rules just now, but follow along, right? Wave 2 is the pullback. Wave 3, I'm talking like this is skyrocket. We're exploding, right? This is the one, this is the move that everybody wants to be in. The broader public recognizes the trend. Volume surges, price rips through inefficiencies like volume nodes, levels of resistance. Like, it's butter. Like, it's butter. We're flying, right? Wave 3 must be the longest of the motive waves. It cannot be the shortest. Mathematically, it's often 161.8%. If that sounds familiar, golden ratio. And we'll talk about that in just a minute. So that's wave 3, big move up to the upside. Wave 4, bro, we're having another pullback and we're chopping around. We're consolidating. So aggressive early buyers who caught this move from the very start are starting to sell off. We're distributing shares to late retail traders, and this is often choppy, and it's consolidating. And wave 4 has another rule: it must be above the peak of wave 1. If it dips below, the structure is broken. And we have the final wave from the motive phase, which is wave 5, the final FOMO push. This can go far, yeah, but usually it's exhaustion. It's trend exhaustion. Retail traders see this trend and they see this as the last push. Fundamentals are peaking, optimism is at its maximum, but smart money is quietly exiting. Wave 5 often shows divergence, right? We're making new highs, but the momentum isn't there, right? So the setup for a proper correction is coming because, yes, as I said before, asset classes cannot go up forever. So this is the motive phase, right? So let's talk about these rules even further. Essentially, from the origin of the breakout, wave 1, wave 2 cannot come all the way down here, right? It cannot break this. Like, it can come down here, it can come down here, but it can't break this entirely, or else we don't have a proper pullback, right? That's just annihilating what wave 1 did. And then wave 4 essentially can't do the same. It cannot annihilate the peak of wave 1, right? It just has to be a proper pullback for wave 3. And wave 3, bro, wave 3 got it for real. Like, wave 3, it just got to be the biggest for real. It just got to be the biggest move out of all of the 8. Wave 5 can rival it, sure, but wave 3, just mathematically, it just has to be the biggest move. This is where all the movement is. This is where the momentum is, right? And within the Elliott Wave Theory, it's broken down further. If you're a trader, or if you even have any trading knowledge, this looks like a uptrend. You have higher highs, higher lows, higher highs, higher lows. Boom. It's broken down into impulsive and correction, or corrective, right? So moves up are impulsive because we're following the trend. Moves down, correction, impulsive, correction, impulsive. Because we're going with the trend, whatever, right? It's just higher highs, higher lows. Keep it simple as that. And now, let's talk about the way simpler one. Like, this is so easy. So we got the correction phase over here. And it's a 3 wave count, as I said before, right? So I'm going to use this tool. And let me tell you what this really is. Wave A is exhaustion, right? After wave 5, the trend starts to crack. The smart money is selling. Public sees to see the pullback and thinks, hey, I'm buying, I'm getting in a position. It's just another dip. The asset is cheaper. But this is the first real sign that, hey, the bullish sentiment is gone. We're not going any higher than this, right? So let's establish wave A. Boom. Wave B looks something like this. I made it too big. Oops. Anyway, right? So price rallies back up on lower volume. This looks like the trend is resuming, but it's not. This is a trap. Wave B is the moment that fools late bulls into adding positions right before the main trap. And wave C, we just have the flush, right? This is the full reset. Any remaining bullish sentiment gets wiped. Price drops aggressively, often matching or exceeding the length of wave A. The market is now seeking new balance, a new value area on the volume profile. And once it finds it again, the whole 8 wave cycle hits. Meaning that after we have these corrections, it can start to chop and then maybe go higher or maybe even go lower. Who knows? And to reiterate, yet again, We have impulsive, because we're going with the trend. Correction, because a stock cannot go down forever, or asset cannot. We have impulsive again. And if we were to put this with the motive wave, what does this really look like? Right? It looks like something like that. That's the Elliott Wave Theory. This is the motive phase, and this is the correction phase over here. Let me type that out. Correction phase. This is essentially what it is, right? But like the AMT theory was straight stats, probability, all that good stuff. What is the Elliott Wave Theory? What are we basing this on? Just human emotion? We can't track a metric for something like that. I mean, we have the VIX, but what else, right? So, as I said before, we have the Fibonacci, right? So the Elliott Wave Theory is not just arbitrary. At its mathematical core, it's built on the Fibonacci sequence. 1, 1, 2, 3, 5, 8, 13, 21, 34, whatever. It goes on. You add the two last numbers and you get the new product, right? So 1, 1 gives you 2, 1 and 2 gives you 3, and etc. So how do we do this in practice? How does this work? So if you know how to use the fib, if not, that's completely okay. The fib looks something like this, right? It can look like that. It can look like that. Essentially, you want to place it at swing highs or swing lows, right? Where price can bounce like that. That's a swing low, or it can bounce like that at the swing high, right? And you use it for areas of probability. This could be like places to take profit, places to get in positions, places of support and resistance, right? So how do we use this in the Elliott Wave Theory? So let me redraw the Elliott Wave Theory. We have 1, 2, 3 the biggest, 4 pullback, 5 Zide, right? We have essentially what looks to be a motive wave, a motive phase, right? So let me put my fib. The first move, it's not going to always look perfect because, well, essentially the market's never perfect. Like, this is a really simplified version of the Elliott Wave Theory, but let's really look at it. So you want to place it at the start of point 1, wave 1, and wave 2 should essentially pull back to this 0.5 to 0.618 area. That's an efficient wave 2. If you were to use this, right, so let's say we see a stock have an initial breakout. Where could we get a proper position and catch wave 3 maybe? Plot your fib tool. If we see somewhere at this area, we can be like, okay, price can probably, pump up here, from here. That makes sense. And then wave 2, is like 1% down from wave 1. You want to plot it from the top of wave 1 to wave 2, and then it's like 1% estimately, or yeah. And then wave 3 is that's the big one. So from wave 2, it should be something like this, right? It's not perfect. Yeah, my stupid drawing, whatever. But essentially, wave 3 is about the golden ratio, right? That's why, like, wave 3 is the one, right? 1.618. probable area where wave 3 will be exhausted, and we'll see aggressive sell-off into wave 4. And then the whole 5 all the way to the final impulsive wave is, let me see if I could get this right. Yup, 2.618, something along the lines of that. That is the whole 5 of the motive wave. Yes, you can use this for bearish continuum, but our market is designed to go up, so why bet against, like, it's just not good odds. Like, okay, yeah, if there's bearish trends, yeah, but our market is solely designed to go up. That's how it's programmed to. So why bet against it, right? So this would be the complete, like, 5, essentially, right? From the start of wave 1 all the way to the tippity toppity, boopity boppity. Wave 5 is like 2.618. And if you don't know how to read a fib, it's so simple. You can invert it, and you can place it if you're going from the bottom to a swing high, or if you're going from a swing high to a swing low, or swing to lower to whatever. Right? You can rewind the video and see if you can understand it, but it's not that hard. It's pretty simple. You just anchor it on certain points, and these numbers right here represent price. Right? I'm just on a random stock right now, and yeah, these are your numbers of probability. And when we use the fib, it's essentially a way to forecast, like, hey, like, maybe we can get in a position here, we can sell here, depending on the longer trend, right? And to reiterate, I said that the market is fractal. What does that mean? It's essentially, when you zoom in onto any time frame, you could find the structure playing out on a smaller scale inside of a larger wave. So, like, for example, wave 3, since it's the biggest, it's not going to look the cleanest, right? That means you can have 5 little motive waves within the daily looking like wave 3, which is crazy, right? It's all embedded in each other. It's insane, and it's something to wrap your head around, but it's really nothing more than, like, just this, right? And let's put it all together, right? From the video of the auction market theory to the Elliott Wave Theory in combination, essentially it just gives you confluence, right? The auction market theory helps you play key levels, and the Elliott Wave Theory helps you figure out when to cut your positions, because let your winners run, right? They're winning for a reason. If you're in profit, that's good. And if you have high conviction, let the stock run. And you can use the Elliott Wave Theory to forecast where you should sell and when the trend could be exhausted, right? They go hand in hand together. You could play key levels and you could play perfect trend exhaustion, right? And with that, the auction market theory and the Elliott Wave Theory, they take math, statistics, probability, and they bridge it together with the mechanisms of human psychology. We have liquidity physics and human psychology hand in hand going together. So they're mathematically consistent and mechanically consistent within inside the market. So why doesn't edge decay? Right? This is a question I think about a lot, because like, you want to make money in the stock market. There's wealth opportunities everywhere you look, right? But you don't want to have a strategy that decays, that stops working once you expose it to the public, right? That's where these principles come in, right? They're embedded into the market. So why is it not arbitraged away so easily? Well, the auction market theory describes how buyers and sellers mechanically match orders. That process can never change. It is the market, right? And the Elliott Wave Theory captures that psychological response that humans have under financial pressure: greed, fear, FOMO. That's why most traders don't make it, and you can definitely use this to leverage, right? Those responses are hardwired, and they don't get arbitraged away because they're not a strategy, they're human nature. This is why traders have used these principles for nearly a century, and they're still relevant today as they ever been. As like a random strategy, like, I don't know, ICT, right? They use formulas, statistical patterns, and they become widely used, and they stop working. That's essentially alpha decay. So to really sum it up, That's the full framework. 2 videos, 2 theories, 1 edge for swing trading. The auction market theory tells you where price is likely to react. Elliott Wave Theory tells you what structure the move will take and how far it will go. The volume profile shows you all of it visually on your chart. And once you start watching charts through this lens, you'll start seeing things you've probably never seen before. These moves stop looking random and start looking inevitable. If you find value in the series, subscribe, share it with another trader who needs to see this, or else they're not going to be profitable, and drop your questions below. I read everything. So see you in the next one.